Hey, welcome to another edition of Nucleus Investment Insights. So today, what I really wanted to focus in on is the stock market versus the real economy, and I guess just some thoughts around this, particularly in terms of there's a lot of discussion about US into recession, not into recession. Is it booming, is it busting? And just wanted to sort of highlight that there can be a big difference between what's going on in the real economy or within GDP figures and what's happening in terms of stock markets. And so it's sort of well worth sort of running through and having a look at some of these differences. Just a reminder, anything you hear today, it's general advice in nature. None of it is personal advice. If you do want personal advice, jump into the show notes and book a call with us and we can run through. Also a reminder, hit the like and subscribe button if you'd like to support the show and to so you'll get notified as we go on live. Usually every Thursday at 12:30. Today is a Friday. So yeah, just to kick straight into it. What I wanted to focus on today. So there's this disconnect idea. I want to look at some of the EMs, what's been going on in terms of that, and some of the developed markets as well in terms of GDP. Having a look through sort of this US lens in particular, because the US stock market is quite different to a lot of other stock markets. More so just at the top end of it, in that you've got a lot of companies there that are sort of the mega caps and global stocks, and so we'll talk through those. This idea about who's actually spending money and how do you get corporate profits, and then sort of this comparison between large caps and small caps within the US, and then there's investment takeaways. What does it actually mean for investors at the moment? So so let's jump straight into that. So I've got a chart up just showing, for anyone listening in on the podcast who can't see it, what we're talking about, what we're showing here is the real equity returns versus GDPs. Now, this is across developed countries, sort of 100-odd years of figures, and it's not quite a negative. Well, actually, I think you can get a negative correlation if you just run a line through these charts. In that, sitting at one end of the spectrum over that 100 years is US, South Africa, Sweden, and Australia, sort of sitting at the top equity market returns, but also sitting at pretty close to the bottom of the real GDP. And sorry, both these figures are real, so excluding inflation. So yeah, so it's that thought that it doesn't necessarily, just because you've got a high GDP growth. So Japan had one of the highest GDP growth over that period, but one of the lower stock market returns. So it works across developed markets. It also very much works across emerging markets, and in particular, what we see within those, and in recent years, you've sort of seen this starkly, is that, for example, China, you've got this real GDP growth that's like far in excess of what you're seeing in the stock market. And sometimes that's pretty similar across most of those markets. So this is a study, the chart I've got up showing from 1988 to 2019, so sort of 30-odd year period. Mexico and Chile sit right at the top end of stock market returns, but Mexico sits at the bottom end of real GDP growth, whereas China sort of sitting sort of in the middle, slightly below average in terms of stock market returns, but right at the top of GDP returns. Now, sometimes, particularly in developing markets, this is an indicator that the stock market is a small part of these economies. A lot of it's sort of largely informal. So a lot of there probably is a lot of guesswork, I guess, at the lower end, but you just have a lot of small and medium cap companies within those, and very few large caps. And quite often as well, once you pick at some of these countries, some of the large caps will often be things like resources stocks or exporters. And so their actual performance of those stocks relative to the performance of the country can be very, very different, just because they're sort of driven by global forces rather than driven by forces particularly within that country. As an example, South Korea, Samsung is by far and away one that dominates that index in terms of performance, and so. And because it's such a large exporter to the rest of the world, is what's happening in smartphone sales in the US is of far more importance for Samsung than what's happening in the domestic sort of South Korean economy. And so you can get that real disconnect just from concentration in some of those stocks as well. So and I think that's probably one. We do have some tilts you can get within our portfolios. So we sort of run these core portfolios with Nucleus, and then you can put sort of extra stocks in that you want, or take stuff out. And one of those options is tilts, and a lot of people often are looking at putting in emerging market companies, just because that they're thought of as being high growth. And I guess what I really just wanted to highlight is, you can get you can definitely get some really high growth economies, but the stock market isn't growing anywhere near at the same rate as what the economy is doing. So you just don't sort of equate the two in terms of saying, oh, look, I really want to get exposure to. I've heard India is growing really quickly. I really want to get exposure to India. Let me go and buy an Indian ETF, because you're just not getting exposure to the broader Indian market. You're getting a lot of exposure to, say, some of the big services companies in India, which are often servicing the US in terms of some of these IT services companies. And so if that's what you're looking for, great. But if you're looking for exposure to sort of growth within India itself, you might not be getting what you think you're getting. And that's very true as well of China, in that the Chinese stock market is dominated by, on one hand, some of the large IT stocks, which are very China focused, but they're sort of a bit of a special case in terms of China. They're not the same as the rest of the Chinese economy. And then secondly, you're getting a lot of state-owned entities in China, and the state-owned entities, they're listed, but shareholders are not their number one concern. They're there to full employment and to spend money the way the government wants them to spend money. And so you might be thinking, I'm trying to get exposure to this great GDP growth in China, and just missing it because you're ending up with a lot of state-owned entities that are growing slower than the rest of the economy. And so that sort of leads me on then to the US, which is probably the biggest one I wanted to talk about, because that's where there's all this focus. Is it going into recession? Isn't it going to recession? Are the tariffs going to smash consumers? Are they not going to smash consumers? All this back and forth we're getting around that. And I just want to keep coming back to and show that within the US, that the US stock market is not the US economy. It's not the US GDP. And there's a number of different factors that go into this. The first one I'll start with is just the US dollar and corporate profits. Now, it sounds weird, but people really aren't sure. It's actually quite hard to measure how much profits actually come from overseas within the US, and part of that is, as well, is there's transfer pricing issues. There's you're producing something in the US, or you're at Apple, and you're shipping stuff across to China and back and forth, and there's something, or a car manufacturer, and stuff's back and forth across borders between Canada and the US, and where does the profits actually get generated, and where doesn't it, and what profits are being generated or sort of being generated in inverted commas in Ireland, because it happens to have a much lower tax rate, and it's much easier to switch some of the profits over there, and which profits are genuinely coming from other areas. So it can be all these need to be taken into account, but it's really just an estimate. But the estimates generally are somewhere between 30 and 40% of S&P 500 profits are generated from overseas. And if you think about, say, something like McDonald's, yes, it's a US listed company, but really it's a global company. Yeah, most of its profits are in the US, but it's also got quite substantial profits offshore as well. And so, what does that mean? Is, well, weakness in the US might end up meaning a weaker US dollar, which has been happening recently. And you get a weaker US dollar, actually that means the foreign profits improve for McDonald's. So McDonald's within the US, US dollar goes down. The money you've earned, say, from selling a Big Mac in the UK has now gone up. And so that's where you can get that disconnect between that. So weaker US dollar is often can be good for the US stock market. Then you get and then you get that effect that, look, if say 40% of profits are coming from overseas, then weakness in the US economy if it's 2% weaker than expected, well, that's only affecting 0.6 of the earnings. Whereas if the international earnings are higher than expected, maybe that can actually offset a lot of those differences. So that's one. I'm just going to pop to a quick sales message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right, and then the next one I wanted to talk about was what's happening in terms of corporate profits. And in particular, corporate profits, there's this equation which it's not as bad as it sounds, but let me run through it quickly, because it sort of I guess helps to understand what's happening in terms of profit. So it's called the Kalecki-Levy profit equation. It's sort of over 100 years old, and it's really a macroeconomic sort of entity in terms of how it's stated. And the idea is that corporate profits are a mixture of investment and dividends that minus household savings, government savings, and then the rest of the world savings. And so what it's sort of saying is that there's effectively 3 or 4 different sectors in the economy, or if you thought about it as, say, 4 different sectors of the economy, that you've got corporates, you've got households, you've got governments, and then you've got sort of the rest of the world in terms of what they're doing vis-a-vis the US. And so if you've got and money sort of flowing between these, so if you've got households actually doing savings, that money ends up somewhere. It's either going to end up with governments or it's going to end up in corporates. If it's just saving, or same if you've got government spending more money, which is the key one at the moment, is when government's going into big deficits, so they're spending more than what they're receiving. That money's ending up somewhere. It's either going to end up overseas, it's going to end up as in households, or more likely is going to end up in corporates. So corporates tend to be pretty good when governments are spending money at managing to capture that money and turn that into profits. So that's sort of the idea behind this equation. Now, beyond that, it's a lot more complicated than what that might suggest, that equation. I mean, that's sort of the big picture things. But if you think about there's different elements to that. So, for example, government decides to cut corporate taxes. What does that mean? Well, now the government's in a bigger deficit. It's not getting money that it would have otherwise got. So it's there's $100 billion worth of taxes it didn't collect. Well, that ends up in as corporates making more money, but government's making less money. And so it's that one's pretty direct. But there's lots of other things that sort of go into this as well, and keeping in mind that borrowing doesn't necessarily mean that you're dis-saving, for example. So if you borrow to buy a house, to build a house, then theoretically, at least your wealth is probably staying constant. Even if plus or minus a little bit, but your wealth, you've borrowed $1 million to build a house. You've got $1 million worth of house, you've got $1 million debt. You haven't really changed your net position, but you have actually gone out and invested, and that $1 million has ended up in the hands of companies who are then building it for you, and the multiplier effect of what they're doing in terms of spending. And so that idea of that capex is important within that investment part, and investing as well. It's not about trading. It's not. So if I go out and buy if I go buy a share from somebody else, that's not creating investment. If the company's raising capital and going out and spending that capital somewhere, then yes, that's creating new that's new investing as well. And then the whole idea of that government can create new money effectively. And so where it's creating new money, it's issuing bonds, issuing these government bonds, and then getting out and spending that money. That's sort of one of these things that's really going to drive that equation and mean that you're going to see that corporate profits are higher on that basis. And then finally, that whole idea of that rest of the world saving as well is that that's partly this whole idea of the Mar-a-Lago Accord and all that type of stuff is that if the rest of the world is putting all its savings into the US, what does that mean, and how does that help corporate profits and the flow on to the US economy? So yes, so big picture though, when we get back to that is it's this idea that the US economy, which is an addition of all those subsectors we spoke about, that is not the same as what's happening in corporates, right? And if you have a look at, say, that, let me just pop that up as a slide for you. If you have a look at, say, the corporate profit sort of based on that equation, and then sort of looked at that versus the corporate profits that get reported the other way, it's not exact because this is it's an estimate, but it's actually a pretty good indicator over time of where profits are actually going. Now the next part of that is that it's this idea that mega caps are even more so not the GDP. So if you look at mega caps and companies like Nvidia and Microsoft and things like, and companies like that, they're not they're not necessarily telling you what's going on in the broader US economy. So, for example, in terms of employment, 45% of the US employees are small businesses. About the same percentage, slightly less than that, of GDP is in small businesses. So already you're cutting out almost half of the US economy. When you look at just a business, when you're just saying just corporates within that, then you add in government spending and government employees, and the government employees estimates are again weirdly imprecise in terms of what you can get from that. But there's a lot of employees as well that sort of contractors and subcontractors and you're a cleaner working to clean the Pentagon. Are you a government employee? Probably not. You're probably a corporate employee, but from one perspective. But well, if every day you go into the Pentagon and clean it, well, you're pretty close to a government employee. And so, if you add up those, you can sort of get to 20% out of the employees and 30% of the GDP. And so that's sort of showing that you're adding just small businesses and governments, and you're ending up with 75% of the US GDP, which you can sort of derive from that. And so, yeah, one more factor. Corporates are not the same as that profit equation I showed you from before. Yeah, sorry, that's where I was coming back to. That profit equation I showed you from before, where are corporates capturing that money that the governments are spending? That is not necessarily the case in terms of that. And then that flows through into this idea that are large cap companies, can they actually do better than small cap companies within this factor? And my short answer is yes. Let's go to one more quick sales message, and then I want to come back with sort of investment ideas and investment thoughts coming out of this.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. So coming back to the investment ideas behind this. So there's sort of four big things I just want to sort of push through. First is this idea that we've been seeing a weaker US dollar, and that's been a positive for large cap stocks. Not for all large cap stocks, if you just US focus, that's not the case. But for multinationals within the US, that sort of means this higher profits just flows straight through. The second part then is these larger, still on that same basis of this idea of international versus Australian, is that the idea is that you have got sorry, lost my lost my IT for a second there. So the second part is that if 60% of the profits coming from overseas, and 40% of the profits coming from overseas, higher for some companies, lower for others, is that also translates to a different effect for companies. There's very much this idea that with the trade tariffs and trade barriers going up, large caps often have these. It appears, certainly within the companies we've been looking at, that more often than not, they seem to have a better. They're better to handle that better. They've got better pricing power. They might have, say, factories in 5 or 6 different countries, and they can just choose to shuffle things around a bit. And now they're delivering goods to the US from whichever country happens to have the lowest tariff that week, and shifting other goods elsewhere. Whereas if you're a small company or a medium-sized, and you've probably only got one main supplier, at best you might have two, and then if you do want to switch suppliers, it's difficult. You've got to build up new relationships. You've got to then go and convince somebody that's worth doing a few $1 million worth of whatever goods you're producing, and things like that. And then only to find that you've decided you want to. China was too risky, and you're gonna shift everything to India, and the next thing, India's all of a sudden got a 50% tariff because Trump decided that they're buying too much oil from Russia. Or Brazil, all of a sudden you've shifted something to Brazil, and next thing you know, Brazil, which has got, you might have, on Liberation Day #1, you might have taken the view that, hey, actually Brazil's got a deficit, actually runs a trade deficit, so they're likely to have one of the lower tariffs. I'll shift things into Brazil, only to find that all of a sudden they've got one of the highest ones because Trump doesn't like Bolsonaro being in prison. And so, that idea that as a large cap, you've just got a more diversified supply chains, you've got more pricing power, you've got more ability to move things around, means that, and you've got a legal team that can interpret this stuff and get the answers. Tends to mean that you're probably in a better position within that as a large cap versus a small cap. Secondly, is this idea of the high government spending and running deficits in the US is going to be supportive of corporate earnings. And what we've seen in the past is that the large cap companies are better at grabbing that. And I think under a Trump regime that seems to value doing personal deals, or at least having CEOs come and pledge their allegiance and talk about how much they're going to be spending and what new factories are going to be doing, you're more likely, if you're a large cap company, to be able to do a deal. So you're Apple, and Trump's putting tariffs on China, is that you can turn up and do whatever it needs to be done in order for him to then go, oh well, actually maybe I need to do something special for phone manufacturers or whatever it is. Whereas if you're just producing a random widget, then chances are you're just not going to get that meeting with Trump, and you're not going to be able to sort of organize a special deal for yourself. So all that sort of flows to better profits for large cap companies versus small cap companies. And then the final one, this AI capex super cycle that's sort of going on at the moment, where the hyperscalers, your Amazons and Microsoft and Alphabets, all out spending bucket loads of money, like literally hundreds of billions of dollars on capital expenditure. And look, some of that will end up in small businesses, but not that much of it. A lot of it is sort of ending up back in the hands of larger businesses and companies like Nvidia and Broadcom and other companies that are really benefiting from this. And so, it's a sort of another sort of bit of special case in terms of the we've got this sort of super cycle capex going on in this one sector of the economy that's not sort of a broadly diversified one. What you see when you get, say, construction booms across the US, yeah, it's very focused in that sort of construction sector, but there's a lot of going out to a lot of smaller players and a lot of smaller companies and subcontractors and all these other people are all benefiting from that as well. When you're out spending big money on building a new data center, it's not the same in terms of being able to just pull a random construction people off the street and bring them in. They tend to be quite specialized, and you're spending a lot of money on equipment and to actually sort of or higher spec sort of electrical gear to build these things. So it's just not the same type of broad-based capex sort of boom that you might get, say, in a housing or construction boom. So yes, all that sort of flows through onto the investment side. And so I won't go too much into investments and further. That we're obviously writing a lot on this, and we've spoken about how we're our broad position at the moment is that, look, we want exposure to these stock markets. We're looking to try and make sure that there's a lot of landmines that Trump could step on, but if he doesn't step on landmines, there's a lot being thrown at the economy in terms of lower interest rates, in terms of considerably less regulation, AI productivity, all these things are sort of very supportive of the US versus all the negative things that are coming through. And if the US economy could sort of make it through without sort of stepping on one of these landmines, the results are probably going to be pretty reasonable. And we're certainly seeing in terms of, if we're focused purely on corporate earnings within the US, they've been pretty good. We still keep seeing upgrades. There's upgrades to 12-month forward numbers. The growth rates still look pretty reasonable. There's certainly nothing falling off a cliff. Not to say that won't happen, and things can't get worse, and all these things could go wrong. But for the moment, things look still pretty good on the earnings front. So it's just that idea that you can get, and that's what I've been really talking about this time, is you can get a big disconnect between the earnings of companies that are listed and the broader GDP of the US. Anyway, hopefully that's given you some thoughts. Just a reminder, we're usually on every Thursday. If you've got any questions, you can jump in and pop them. We haven't seen too many questions today. You can get all of our content from nucleuswealth.com/content. You can hit us up on a bunch of different social media places. Look forward to seeing everyone next week, and thanks for tuning in.